In today's video, I'll share with you the top 4 growth ETFs that I would recommend you to consider buying in your portfolio in 2023. Growth ETFs are particularly interesting for young investors looking to grow their capital as fast as possible, but at the same time, these investment vehicles have a lot of risk that comes with it. And so, it is why in this video, I'll share with you the ETFs that have the highest potential of growth without having too much risk. But before to take a look at my different picks, let's make a quick recap on what an ETF is. An exchange trade fund, also known as an ETF, is an investment vehicle that holds many different kinds of securities. For example, it can hold different stocks, bonds, and commodities. And so it gives the investors the possibility to diversify their own stock portfolio by also giving them the opportunity to buy different securities on a stock exchange. But now, without further ado, let's take a look at my pick number 1. The first pick on my list is the Global X Internet of Things ETF with the ticker SNSR. This ETF mainly focuses on companies that are at the forefront of the Internet of Things revolution. These companies are offering many great services and products such as the development and the manufacturing of different sensors and semiconductors, as well as smart homes, connect cars, and the traditional internet. It is why you can find companies such as Guardian, Advanced Tech, and Dexcom as the biggest holdings of this ETF. And so, without surprise, you can find the tech sector as the largest sector of this ETF with about 70% of the total assets under management. Plus, when you think about all the tech giants such as Tesla, Nvidia, Amazon, and Apple, they have all one common trait. Well, first, obviously, they are all some technology companies, but most importantly, they all come from the US. And so it is why over 60% of the total companies found within this ETF comes from the US, followed by Switzerland and Taiwan. On your part, by investing in this ETF, you can expect to pay some annual management fees of about 0.68% or $68 per $10,000 invest. Plus, by investing that $10,000 in that fund at its inception on the market in 2016, this $10,000 would now be worth over $24,000 at the moment, which represents a great annual return of about 14% on average. And on their part, by offering some great semi-annually dividend distribution to their different shareholders, this ETF is considered by Morningstar as having a higher potential of return compared to the average of its category, while having the same level of risk. And so, as the world becomes more and more interconnected together, this kind of ETF might see a lot of potential growth over the next couple of years. Moving on to the second ETF on my list, which is the ARK Next Generation Internet ETF with the ticker ARKW. Managed by ARK Invest and their famous CEO Katie Wood, this ETF seeks to invest in companies that notably use cloud computing, artificial intelligence, e-commerce, and other great disruptive technologies. It is why you can find great innovative companies among the biggest holdings of this fund, as we can see by Tesla, that represent close to 10% of the value of this ETF. And you can find other great picks such as Roku, Zoom, and Coinbase. And as you can see, with over 95% of the total assets of this fund, the American is pretty well represented as well. But this ETF has one particularity that no investor should underestimate. In fact, it is that this fund is extremely volatile, as we can see by its latest one-year performance of less 40%. But since its creation on the market, this fund has still returned on average about 15% per year. But as you can understand by the companies in which this fund is investing, the performance of the overall ETF is really acting as a roller coaster. For example, just by seeing its biggest holdings, Tesla, during 2020 and 2021, we can see that it has skyrocketed. But after 2021 and during 2022, we can see that it has lost a lot of value, as so for this fund. But by investing $10,000 in that fund in 2015 at its inception, this would now be worth slightly over $34,000. Plus, by investing in RKW, you can expect to pay some annual management fees of about 0.88% or $88 per $10,000 invest. And on their side, they are making some annual income distribution to their different shareholders. So personally, if you ask me, it is a great ETF for the future because I personally believe a lot in the different companies in which this ETF is investing. And I also believe that Katie Wood has a very long-term vision of investment, which is a great thing, especially for young investors looking for great growth in their capital. Now, the third pick on my list is the Vanguard Information Technology ETF with the ticker VIG. This ETF provides exposure to a broad range of great technology companies such as Apple, Microsoft, Nvidia, and Visa. Plus, as you can see, the vast majority of the 364 holdings of this fund are located into the technology, hardware, and storage, followed by the technology distributor and the semiconductor sectors. And on your side, by buying this ETF, you can expect to pay some slightly higher fees of about 0.97% per year or $97 per $10,000 invest, but these higher fees come with some incredible return of close to 20% on average over the last 10 years. And so 10 years ago, your $10,000 initial investment would now be worth over $68,000. Incredible, isn't it? And on their side, this ETF is also offering some great quarterly dividend distribution to their different shareholders. And at the same time, by having the same level of risk compared to the average fund of its category, this ETF also have more potential of return. So as the technology continue to advance and shape our world, this kind of ETF will be very interesting for all the growth income investors. And finally, the last ETF on my list is the iShare Russell 2000 Growth ETF with the ticker IWO. This ETF seeks to track the performance of small growth companies that are found within the Russell 2000 index, which is an index composed of the 2000 smallest companies found within the Russell index. And usually, those small cap companies have more potential of growth if they succeed. And so, among the biggest holdings of this fund, there are many companies that you must not even know about, such as Super Microcomputers, as well as Shockwave Medical and MCore Group. And the largest sector of this fund is the healthcare sector, followed by the industrials, the technology, and the consumer discretionary. On your part, if you wanted to be successful by picking all the small cap companies and be able to make a lot of profit, it would be much harder for you compared to those kind of funds. Indeed, all the fund managers of these special funds have more knowledge and more different information about all of these small cap companies because at the moment they are not as well known as other big companies such as Tesla and Microsoft, and it makes that the information about those companies are way harder to find. Plus, on your side, by investing in that fund, you can expect to pay some mere management fees of about 0.23% per year or $23 per $10,000 invest. And this $10,000 invest 10 years ago would now be worth about $27,000 or an average annual return of about 8.50% per year. Plus, when you compare IWO with the other kind of funds of its category, you can find that it's pretty much in the average in terms of the risk and in terms of the potential of return. And at the same time, it is also giving some great quality dividend distribution to their different shareholders. So on your side, if you're looking for a great way to capture the potential of these small cap companies, well, this ETF could be the perfect fit for you. Finally, this wraps up my list of the 4 best growth ETFs to buy in 2023. But on your side, if you prefer to invest in ETFs that are giving some great monthly dividend distribution to their different shareholders, well, you can check out the video that's going to be right over here, and I will see you soon. Peace!